Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey everyone, and welcome to The Explainer. You know, for real estate investors, there's this incredible tax strategy out there called cost segregation. Today, we're going to break down exactly what it is and how it can help you unlock hidden value in your properties and seriously reduce your tax bill. All right, here's how we're going to tackle this. We'll start with a common problem for high earners. A good problem to have, sure, but still a problem. Then we'll build up to the really powerful solution, and finally, we'll talk about why this is such a big deal for your long-term strategy. So let's kick things off with Section 1, the high-income tax problem. And yeah, it's one of those classic good problems to have, right? But hey, it's still a problem. I mean, have you ever felt this? You're working hard, your income is growing, but it just feels like your tax bill is growing even faster. It can feel like you're on this treadmill, and it really limits your ability to reinvest that money and grow your wealth the way you want to. Okay, so what's the workaround? How do savvy investors handle this? Well, they use this really clever strategy that involves their real estate investments to generate losses. But here's the kicker. They're only losses on paper. So here's the goal, right? You want to create what's called a paper loss from your real estate business. And if you qualify as what the IRS calls a real estate professional, which basically just means you spend the majority of your working hours in real estate, you can use that paper loss to wipe out taxable income from your day job or your other businesses. It's huge. And the absolute key to this whole thing is this idea of a paper loss. I want to be super clear here. This is not you actually losing money. No cash is leaving your pocket. It's purely an accounting move. And the main way you generate it is through something called depreciation. Okay, so let's talk depreciation. What is it? And more importantly, why is the normal, standard way of doing it, well, just way too slow if you want to make a real dent in your tax bill? You know, depreciation is an amazing tax benefit. The government basically lets you deduct a piece of your property's cost every single year because, you know, buildings get old, they wear out. But here's the catch. The timeline the IRS gives you is incredibly long, and that's where a ton of investors are just leaving money on the table without even realizing it. And this chart, it lays out the problem perfectly. The IRS says, okay, a residential building, you have to write that off over 27 and a half years. A commercial building, even longer, 39 years. But then you look at the stuff inside the building, the carpets, the appliances, all that personal property, that stuff gets written off in just 5 to 7 years. And that massive gap, that is exactly where the opportunity is. Right. So that huge gap in timelines we just talked about, that is precisely what cost segregation is designed to take advantage of. This is how we speed things up, a lot. So here's the big mindset shift. What if you stopped looking at a building as just one single thing? What if instead you saw it as a collection of hundreds of smaller assets all put together? That's the core idea of cost segregation. You're basically unbundling the property into all its different pieces. So what this means in practice is you bring in specialists, engineers, accountants, and they do this super detailed study of your property. They go through it with a fine-tooth comb and identify everything that can be legally reclassified. We're talking carpets, light fixtures, cabinetry, even some of the specialty electrical systems. All that stuff can be moved from that long 27.5 or 39-year schedule to a much, much faster 5 or 7-year one. Okay, let's put some numbers to this so you can see just how powerful it is. Let's say you have a $500,000 property. Using the standard slow method, your first-year depreciation deduction might be, maybe $5,500. Not much. But after a cost segregation study reclassifies, say, $150,000 of components to a 5-year schedule, bam, your first-year deduction jumps to $30,000. That is a massive difference, and all we did was change the accounting. But hold on, it gets even better, because there's this other tax rule you can layer on top of this. Think of it like a supercharger for your deductions. And this supercharger has a name. It's called bonus depreciation. For 2023, this rule lets you immediately write off 80% of the cost of all those short-life assets we just identified. It's just a huge upfront deduction. It is important to note that this percentage is scheduled to go down in the coming years, but for now, it's incredibly powerful. So let's go back to our example and see what happens when we add bonus depreciation into the mix. Remember, we started with a standard deduction of just $5,500. Cost segregation alone got us to $30,000. But with cost segregation plus bonus depreciation, that first-year deduction skyrockets to an incredible $120,000. Just like that, you've created a massive paper loss you can use to offset your other income. And I have to say this again because it's so important. The building itself hasn't changed one bit. It's the exact same property. This is all happening on your tax return. It's a completely legal, well-established tax strategy that just unlocks these huge, immediate tax benefits. Okay, so right about now, you're probably thinking, wait a second, this sounds great, but aren't I just borrowing deductions from the future? I'm taking them now instead of later, but the total amount is the same, right? It feels a bit like a timing game. And you know what? That is an excellent question. It's totally logical to think that. Are we just robbing Peter to pay Paul here? But the answer, surprisingly, is a hard no. It's much, much more than just a timing trick. And there are two really big reasons why. First up is the time value of money. A tax dollar saved today is worth far more than one saved 20 years from now. By deferring your taxes, you've essentially given yourself an interest-free loan from the government that you can turn around and invest immediately. And second, and this is the really pro-level stuff, this strategy pairs beautifully with other tax laws. You could use a 1031 exchange to sell your property and roll the gains into a new one, or upon inheritance, a step-up in basis could potentially wipe out the tax liability on that depreciation altogether for your heirs. So, one really important note here. This is not a do-it-yourself project. It requires a formal study from engineers and tax specialists. But the great news is you can do this at any time. Even if you bought a property years ago, you can do a study today and catch up on all those missed deductions. It's super flexible. So when you boil it all down, cost segregation really gets you to ask this one powerful question about your own portfolio. What hidden financial potential could you unlock if you stopped looking at your assets as just single, big blocks, and instead started seeing them for the collection of valuable components they really are? It's a shift in perspective that can open up a whole new world of tax efficiency and long-term wealth creation.